Sylvia's Traders Lounge, in partnership with Scope Markets, welcome you to yet another webinar where we learn, trade, and profit. We shall be giving you trading insights on technical analysis, fundamental analysis, risk management, and trading psychology. Today's guest is Matthew Tucker Sparrow, and our theme is Application of Python in Financial Markets for Automated versus Manual Trading with a Bias in Currency Spot FX Trading.
All right, Matthew's trading bio. Matthew Sparrow, CMT, is a market strategist, technical analyst with 20 years experience covering global macro instruments, Forex, fixed income, equities, commodities, and emerging markets. Matthew started out as a manual prop trader, but transitioned into automated trading, designing quantitative trading systems for commodity and equity instruments at Kashna Trading Group and T3 Trading. Matthew currently covers global macro markets at Informal Global Markets, where he uses Python to create quantitative trading models, signals for clients worldwide. Welcome, Matthew. We're delighted to have you. And maybe you can start off by telling us, from your extensive research on technical analysis, you can explain to us what quantitative trading means to you and how you employ quantitative studies to generate your trading ideas.
Sure. Well, thanks for having me, Sylvia. It's an honor to be here. So quantitative trading, quantitative strategies means to identify significant statistical relationships with market phenomenon. It's a way to research ideas and see how certain factors or anything that you notice in the market, how those things have panned out over the long term in the markets, which can be very useful because there's a lot of, you turn on the television, you know, you hear a lot of people giving opinions, or there's, even within technical analysis, there's a lot of notions or ideas that people just assume to be true, but it's a way of testing an evidence-based approach to see how predictive these ideas can be.
Right, so how do you do that when it comes to your trading? How do you use quantitative studies to generate your trading ideas?
Well, I can get into much greater detail and show examples when I get later on into the presentation portion, but basically it breaks down into isolating a market phenomenon, something that you see. If you're involved in the markets, you might, notice a certain pattern or occurrence. For instance, the market changes dynamics towards the end of the day. Equity markets, there's more volume, so you might think, oh, I'm noticing like these stocks tend to do this, like rise if at the end of into the close if they were down, or something like that, some relationship. And so you quantify that programmatically within, well, I use Python, which is, that's a whole different issue in terms of picking it, but it's just a very easy language to use. You get data from, you can pull that from Yahoo or other sources, and then you can test how that happened over the long term. And so it's basically scaling out. You notice something, but our perspective is limited. We can only see so much with our eyes, right? So it's a way of seeing what happened when this occurred every time that it's ever happened. As much data as you can get your hands on. So it's really powerful.
All right. And so as a technical analyst, when it comes to automated trading, how does that help you curb against emotional driven trading? So when we talk about mass greed and fear.
Well, one of the main benefits of it goes hand in hand with doing the research and seeing how things happen. So you're getting hard evidence on what happened, and so you knowing that I don't want to say it 100% removes emotions from the process of automated trading, because if you have a system that's in a drawdown phase, you're going to be emotional about that. There's always the question of, systems and models are cyclical, so they can be profitable for, even up to like 10 years, with some portfolio models, but at some point they won't be, they'll cycle out. And so there's always going to be some emotion, but it's relatively speaking, and there's behavioral finance gets really into detail about all the different factors that can hamper someone's ability to trade rationally. There's a whole, all different, it's really fascinating how people are influenced by herd behavior or by following someone else, or, anchoring. There's all different factors that can negatively impact your ability to trade rationally. And so by using an evidence-based approach, you remove that, at least in the research phase, entirely. And then if you're executing that moving forward, you've removed it entirely, but not accounting for what I just spoke of, that there's going to be some emotion and when you're watching the profitability of a system.
All right. And maybe you can tell us the benefits of, using systems trading in high volatile markets such as Forex trading.
Sure. Well, that's interesting because there's actually, I don't know if you've heard of it, but normalizing your position size based on volatility is a great approach. So for instance, if you had, let's say, two currency pairs, or it's easier to think about with an example of a stock, two stocks where they both trade at $50, and if you invest the same dollar amount in each stock, but one has an ATR, which is, your viewers might be aware, probably aware that it's, how the volatility, how much it actually moves, the average true range for that day. If one moves on average $2 a day while the other moves $1 a day, your risk is actually double for the stock with the higher ATR. So you don't want to be investing the same amount in a dollar, based on dollar investment. So you actually want to be trading half as much. So there's actually a formula you can use. You just divide the amount you want to risk per position divided by the ATR for stocks. It also works for any financial instrument. In that way, you eliminate, as volatility increases, your position sizes go down. So you're essentially trying to hedge the volatility risk out. Now, volatility can change at any point, and you might have to rebalance depending on your investment horizon. But it's very useful to hedge the volatility out. And that's also wanted to add that using volatility normalized positions in any system really is going to improve the risk adjusted return. So it's like, you don't want to judge a system based on that. You want to judge it based on just the core idea performance. But when you're getting close to going live, that's something you usually want to add is what I just spoke about.
Right. And because you've been at this for like 20 years, and I know Python was, it's just a modern coding language.
Yeah.
How did you start out with programming languages, and why is Python like your go-to language when it comes to now your trading?
Well, I can just answer that second part really quickly. Python, it's very useful because it has a huge user base first and foremost. And so if you have any question that you have about processing data or how to do something in your program, a quick Google search is going to give you 9 different individuals who have already asked the question on Stack Exchange, and you can get really good informative responses. On top of that, it has a lot of amazing open source libraries, which I'll get into a little bit later. So you just import pandas, and there you go, and it's got all sorts of different functions that are it's super simple. The language is really easy to read and write. Programming for me, when I first started off, I was a prop trader, and I traded basically one stock. I was trading equities, and I was basically a de facto market maker, and I would just read the tape, and I would just look at the order breadth, and I would trade based on when orders would come in. And so I started to think, this is, at the same time, there was there was an opportunity to go work with developers at other firms, and I started to think of programmatically and how this could actually be quantifiable. It's really just you're looking at the ratio of bids to offers, and then you can put in filters like as long as the spread was within a certain range, then it would execute orders. This was basically, it was an opportunity to scale out my trading style, and so that was really cool, and I was able to do that. But the markets are always changing, and so eventually, market makers understood how we were reading the tape successfully, and they devised all sorts of tactics to disguise the order flow. They would spread it out among different providers, and so basically that stopped working. And then I actually went on and started to do some research with some systems development. I was studying for the CMT, and I'd already done some work with some systematic trading gold futures. It had some success with that. And so that was, I'm kind of going backwards now. So that brought me up until, the modern later phase of my career where, we use it pretty extensively now at Informa Global Markets, where I'm currently working.
All right. So maybe just before you go to your presentation, would you say like most traders, because you're based in New York, are pro Python, or are they still using like C++ or any other languages for trading?
Yeah, well, C++ is much faster, and it's implemented, especially with high frequency trading operations, and that's not something that I'm involved in. I'm more in the research, and the trading that I do is more mid frequency, long-term frequency. Looking at keg signals off the daily closes, stuff like that. So yes, I mean, people will also use R a little bit because that's a little bit easier even than Python for some of the hardcore statistical based stuff, just with stuff that's built into R. But it's much less flexible than Python, just given what I was highlighting earlier in terms of the user base and the number of libraries. Python can just, it's going to connect to APIs for trading APIs, stuff like that, whereas R is going to be a little more convoluted to get that up and be more limited.
All right. At this point, maybe you can take us through your trading process and, with the use of Python, of course, and also just explain to us what your day-to-day trading basically entails.
Sure. Should I share? Is it okay to share my screen now?
Yes, please.
Okay. Can you see my screen now?
Yeah.
Okay. A little bit more on the research process, and you can see how this all goes into the trading decision process. One of the things that I built here that we use at work is what is referred to as an event study. And so when you're thinking about, and I alluded to this a little bit earlier, when you're thinking about quantitative trading, systematic trading, you are identifying something that occurs in the market and that you think might be able to lead to some sort of predictive outcome in the foreseeable future, in the near term. So one thing that's great, this shows you with Python. So this is a script called performance consecutive days. And what this does is, and we'll use this in a commentary too, because you'll see runs, where an instrument closes in the same direction X number of days. And I've done research on this in equities in the past with various different setups, gaps, runs, especially when price is relative to a moving average, if it's overbought, oversold. But so here is a script that, I got to use let me highlight this. Where's my pen? Okay. So up here, you can see the parameters. We're going to look at dollar NACI. This is the ticker is NOK currency for Bloomberg. This is where I'm pulling my data from. So we're going to see what happens when zero is a down close, and what happens following 1 day, 5 days, and 21 days. So 1 day, the next week, and the next month following this type of a move. And so let's get that out of here. Sorry, I'm not used to using this annotation. There we go. So I'm just going to run this up here. And this is, you can see with Python, it's always slow when I run it the first time each day. This is a little bit longer. It's not the most elegant program, but for each day, I created a separate block. So it's a little bit longer, 300 lines. But so you can see here in the bottom right here, this is the output. So this can tell me quickly. This is a great example of, oh, let me look at a chart and let's see what happened the last 3 times that dollar Naki closed down 5 days. And you look with your eyes, and it's probably even hard to look back and find that, but I can quickly see with the script, which took about 10 seconds to run, that since the year 2000, January 1st, this has occurred 153 times. And these are the percentage of up moves following such a move. So 1 day after 5 down closes, 53.6% of the time, the pair is closing higher, but actually, so that's kind of a snapback reaction that they're actually going to see some follow through here. So only 42% of the time, 42.5% is it trading higher 1 week later, and 44.4% a month later. And then this is the cumulative plot of each of these. You can see the 1 day, 5 day. So there might be something here, and this is your baseline for something like this is 50%, which would be, a random coin flip. So if you start to see anything into the, you need to think opposite here because this is down move. So anything that's like 55% upwards to 60% occurrence. So this would be, 57.5% closes lower 1 week later. That looks pretty significant. So this is just, and then another one here, a common thing within technical analysis is the moving average cross, right? So you'll hear about the bull or bear cross. So this is the one I built. If you look up, call your attention to the top left here, just highlighted, this is easier. So, and again, this is great with programming. I can look any number of days out. I like to look at 1 day, 1 week, and 1 month, and any moving average. And then we're going to say, okay, a bull cross. What happens after a bull cross in the USD index, which is the DXY currency? We could look up anything, that we have data for. So let's run this. Here we go. And so this is, when I remember when I first wrote this, is looking back to 1975. I was a little surprised, but it's only, you've only seen 29 bull crosses since 1975. And what's interesting here is you'll see it actually 1 day after the bull cross, you will see there's always some noise, especially in currencies, but, it's actually pulling back the next day more often than not. But then you'll see follow through 1 week later and 1 month later. 62% of the time is trading higher 1 month later. And you can see that in our green plot up here. This is also the mean return of those, and it's returning 45 basis points 1 month later. So that's really interesting. I also built one here for percent change. So I'm just kind of giving you the idea of like the initial phase of research. I'll get into a specific system here in a little bit, but one more thing that I built recently, I'm gonna run this. We did a study on the correlation between certain instruments and Brent oil, given the huge sell-off in oil recently. And what I did was I did a rolling plot of the 3-month correlation, and we'll look at the, so here you go. And this is the 1 year correlation matrix, which is give you the snapshot of, the present, like up to like 1 second ago, and I ran this. But what's more interesting here is this rolling plot of the 3-month correlation of all these instruments to Brent. Especially the screen is the S&P index, and so you can see this is during the historically quick coronavirus outbreak sell-off, and the oil was tanking at the same time, as you guys are all pretty aware. You can see that the markets became pretty closely related. You saw all these, and so these, the dollar real, dollar CAD, dollar NAKI, and dollar ruble, which are all influenced, have a large component of their movements can be explained by the movement in Brent oil or even WTI. You can see as the correlations change over time, but they became, these are -1 because it all depends on the relationship of the instrument. So, you know, they were going down. I'm sorry. Yeah, they were, because dollar is the base currency. So -1 just means it's highly correlated inversely, but it's just because of the base currency relationship in the pair. Anyways, you can see those relationships starting to peel off, but this is a good example. You can look at correlation studies, and then you can come up with a pairs trading idea. This is just really simple stuff too with Python. I know that's, you know, and look at this. This is just, you know, 70 lines of code. Something as simple, where are we here? Where's my correlation? So right here, and this is just, look at this. We've got 1, 2, 3, 4, 5, 7 lines of code or whatever it is. And with pandas, I can just call a rolling, and then I can change this, the correlation window. We have this up here, which can be changed. So it's 3 months, rolling, correlation. And then you're gonna have, the first argument is what is it correlated to? We're examining the relationship to Brent. So, I mean, this is, you know, Python coding is beyond the scope of this presentation, really. There's so many resources online, but like it's still, it's just, even if you don't know any coding, you can look at this and kind of understand what's going on. Another thing that was really cool that we use at work is this. I do a volatility table to show the relationship, but I built this thing called the trend state table. And so all traders are going to be familiar with moving averages. And so I created a script here that looks at the relationship of the current price versus 3 moving averages. And we're using a 1 month, 3 month, and a 200 DMA. And then it describes, it gives a classification based on those relationships. And again, like you can see here, so we have our 3 moving averages here. This shows you how easy Python is to read. We're right here right now. So if the close is greater than, and T1 just stands for the different moving averages. So we got our short, medium, and long-term moving average. If the close is above all 3 of those, it's trending up. If the close is below all 3, it's trending down. If it's below the short-term moving average, but above the medium and long-term, it's minor easing, and so forth. And so let's just run this. So it's very useful to get a quick snapshot, and I'm running this right now just on the major currency pairs that we cover at Informa. But you know, recently a colleague was a panelist you know, speaking on a panel, and needed, you know, 50 currencies, and I just threw them in there, and then again you can just put in any list. And she was, you know, needed to be aware of, you know, current states in case the question came up, what her opinion was on certain, and you can see down here on what things looked like in terms of the trend states. So here you can see, so this is run on a monthly chart, a weekly chart, and a daily chart. So that's the thing, you might, you know, your viewers might have seen this, where you want to look at multi-time frame when you're trading. You know, you want to see, you know, something might look good on the short term on the hourly chart, but you know, you could be, your setup could be going up against something in a higher time frame, and the higher time frame is always going to have a stronger trend. That's just something that, you know, that's just the way things work. Everyone's probably aware of that. So you can see quickly here, this gives you the relationship of the price, current price, to all 3 of those moving averages. So we have all these here, and then this gives it just a quick recommendation based on what to do. So, you know, if it's strong on the monthly chart, strong on the weekly chart, but it's pulling back on the daily chart, then that makes sense. You want to be buying dips. Now, what's interesting is, so this shows you the thought process. You're like, okay, let's test that. Let's write a program which, or a script here, which actually test the performance of these. And so I did that. And what was interesting that if things are trending up or trending down, all three, because given the high reversion factor with currencies especially, that they're actually, the performance was not good. But then what I tested was, and I'll show you with this script, let me just run it first. Again, it's really easy to read the program logic. Where are we here? Sorry. Oh, I'm in the wrong one. Where am I? Just bear with me. Okay, so right here, this block of code right here handles the entire back test. And so all I'm saying is if the monthly chart is trending up, but the daily chart is trending down, and then vice versa for short, if it's trending down but trend on the monthly but trending up on the daily, buy or go long every day where that's occurring the next day. And so this gives you a quick plot. Now you can see this combines both. This is the cumulative performance of the strategy. It's got a big drawdown. So we'll get into this later. I guess we can talk about it now. One of the things that is key to analyzing system performance in setting up a model is what people call the KPIs, or the key performance indicators. First and foremost is your risk-adjusted return, and that just normalizes your annualized returns normalized over the annualized volatility. And so this has a Sharpe ratio of about 0.5, which is decent for FX. I mean, it's not anything that you're gonna, write home about or anything like that, but we can just go through these a little bit here. You have your average returns, your annualized return, annualized volatility, profit factor, which is another kind of risk-adjusted return metric, which measures your total winnings divided by your total losses. Max percent drawdown is key, especially your return on total return divided by max drawdown. This is about 2, ratio of 2, which is fair, but this is a really big drawdown. This, it looks like there's something going on there, but their work needs to be done on that a little bit. Now I want to kind of switch gears here, and let me just look over here for a second. Sorry. So I don't know if your viewers have heard of John Ehlers. He's written a few books using cycle analytics with signal processing and applied that to analyzing cycles. And what's interesting is that, and going back to like why Python is so great, one of the libraries, you can get it in R too, but you can get it in Python, is the TA library, TALIB. And they actually have some Ehlers functions in there, which you can just insert right into your script. So let me get back here. Sorry, I've got so many scripts. So I created this. Let's see here. Before I get into like the details of the script, I want to start. Let me just run this first, because this takes a good couple minutes to run. But I want to talk about, and I can show you the code here, downloading these tickers. Then I'm going to get the data here. But what's great about pandas is that I can just create columns, and you can think of pandas as like Excel, but much better. It's a 2-dimensional array, and you you can start to see here. I also
doing a webinar.
We weren't broadcasting our smooch, were we?
No.
I can hear someone talking. Sorry. And so you're going to see. Just want to say this quickly. I know it's talking about pandas, but you can see the performance for each of the G10 instruments that we're running this on. And it's important to see that you start to see these are the equity curves. And so they're going to look good for these first two, but you see, here you go, this is a big drawdown with sterling. You want to look at the aggregate performance. So that's an important point that I want to emphasize here. While I was looking at these event studies earlier, something might look good for one instrument, but that could be highly random. And I actually have, well, I'll show this once this finishes running, but you can actually create like a random walk script, and you can actually, I'll show that to you, that it can be misleading that, you know, this could actually be not something like this necessarily, but something like this, where you're like, oh, this has a positive expectation with dollar CAD. You know, you can draw use a random walk script and have something that looks just like that. So it's important to test your ideas on as many instruments as possible, on as much data as possible. We're about 60% done here. But with pandas back over here, what's really cool is that you can just create, this is my pandas data frame. It's called ticker. And then I can create all columns in these, and I can show you this once this loads. But these are just the TA library functions that I'm calling on the close, and that's going to create a whole new column in my data frame. And then we can just build a toy strategy around that to get a quick assessment of the predictive power of an idea. And we'll get into that. Just bear with me. Again, this is running on 45 years of weekly data. So it's just to give you an idea of how powerful, you know, research can be. Obviously, you can never do that with your eyes, and it would be inaccurate. And so here we go. I'm gonna move this because this is in the way for me. So you can see here, this is the aggregate performance of this strategy, which I'll explain to you in a minute, but it looks good. It's in a sort of a drawdown over the last couple of years. These are the individual currency pairs. Then down here, we have the aggregate returns. Again, this has a Sharpe ratio of 0.5. Directional symmetry, which is just a fancy way of saying how often we call the direction correctly. So this is 55% over 45 years. It's pretty good. So I feel like I just went in 9 different directions there a minute ago. So let me just circle back here. This is one of Eller's well-known indicators. Is called an instantaneous trend line, and it uses a lot of advanced cycles techniques to essentially what it does is it minimizes lag. All regular moving averages are going to have a lot of lag, and so that reduces their usefulness in a short-term trading environment. You know, even like on a day, when I say short-term, I mean up to like a week. It's all relative to the time frame you're looking at where you're getting your data. So this is just a simple strategy that, again, there's all this fancy code to get it going, but then when you're actually just building the logic, and let me open up one of these tickers here. It's under data. Here we go. And we'll look at dollar stocky. So this is my pandas data frame. And as you can see, ooh, lost it. That's right, I can't. Okay, let's open this quick. So you can see here, it's just like an Excel spreadsheet, but you know, you have all these different columns, which I've loaded, and we can look at the relationships of values here, which is something you could see on a chart. Let me just close this, move this out of the way for a second. So all this, going back to this block here, all I'm saying is if this instantaneous trend line trigger from today is greater than yesterday's, I-1, then we are going to take the returns from tomorrow because we don't want to have look ahead bias. We would be trading when the signal came in at the close of the session, and we would open our trade the next day. And so you can get more accurate and say, the returns from open to close the next day. But again, this is just what we refer to as a toy strategy, where you're just getting a quick assessment. It's all done within pandas. And so let me see if I have my return. So essentially you would just be saying, I'm not going to be able to, I have so many different columns in here. But you would look at the relationship between, let's say, RSI and RSI slow, and then if that's what the model describes, and you would take the returns the next day, and that's it. You're just working with a two-dimensional array. You're just working in pandas to quickly, and then you're gonna quickly capture those returns, and then you have all your KPIs. I copy and paste these from earlier scripts, and then drawdown, Sharpe ratio, and then that just gives you a quick assessment of how things look. I want to quickly show, I built this random walk script, and this is just going to plot a random walk, which is just a random if. It's going to generate a number between 0 and 1. If that number is below 5, it's going to give a -1, or it's going to give a 1 if it's above it. And so it's completely random, but we're going to draw some plots here. So you can see just right away, like this is completely random. And human beings, we were talking earlier about cognitive biases, and people don't understand. One of these is that people don't understand the extent to which runs can happen within a random structure. And so you can see like right here, right before 4,000th iteration, you start to see a drop off where if you didn't know any better, you'd say, oh, wow, if you told someone this was a stock, they might say, well, what was happening? There was obviously negative sentiment. They would start to create a whole list of ideas to try to explain what's happening, but it's completely random. And what's cool is this can keep, every time I click it, a lot of these look more random. Some will look more random than others, but like here you can say, oh, this is trending up. And then now, you can start to even see, oh, there's resistance around 60, but it's completely random. So you really have to keep this in mind as a trader and as an analyst, because it's so easy. There's such a large component of noise in FX and in financial instruments in general. It really complicates research compared to other domains, especially with machine learning and stuff like that. It makes it really challenging to identify signal as part of that noise. And so you really have to keep this in mind. That's why it's important. I wanted to use this as an example when we were comparing this to these equity curves. So it's just really something good to keep in mind. Switching gears. I also wanted to mention here that if anyone is new to Python, Python is just a programming language, but I would highly recommend the Anaconda package, which is what's called an IDE, or an interactive development environment. And what this part of Anaconda is the Spider IDE, I should say. And what's great because any Python or any programming language is going to come with a script editor and a console output. This is our console down here on the right, and this is our script editor up here. But what's great about Spider, and I've seen this in some other IDEs, but it's what's called a variable explorer. And so when you start to program, programming is all about manipulating data and objects. And so without the variable explorer, you couldn't go in and see, I couldn't go in and show you, these data frames. You'd have to just call it. You'd have to have it print to the console, and then it doesn't even print it, because some of these, this is going back to 1975. There's tens of thousands of rows or whatever it is, and it's going to truncate that. And so it's just so much more convenient to be able to go and inspect your data objects. And let's see where we are. So I got data here, and then you can look up any of these these, the values for each day. I want to give an example here of, I'm sure, Sylvia, that, you were interested in the trading process. And so throughout my whole career, you can set up Python to connect with an API and trade automatically, but I've never traded, real high frequency stuff, or even, I did manually, but in terms of systematic trading, it's always been on a daily time frame or higher. So my workflow would be to have the system, quantitatively generate signals, but then those signals would be output and you can have it automatically set, export to a spreadsheet. And then, for instance, when I was trading equities, the system could you could just drop a spreadsheet into the system, and your orders would be entered into the trading system that way. So here is where is this one? This is another model based off of John Eller's with the stochastic RSIs. It's something that he came up, just a combination of a stochastic of RSI, which is an interesting approach, which I tweaked a little bit. But this was on, I built this and then tested it on Bitcoin. And actually, this is something that a friend of mine and I have been trading for the past couple months. And let's just run this. This gets the data from Yahoo. That's really quick, as you can see. These are the returns. This is for 3 years. This has a much higher Sharp, 1.9. Bitcoin has, it's a ridiculous risk. You have an annualized standard deviation of 0.85 of 85%, which is astronomical. But again, it's all relative because your annualized returns are 160%. So that's the Sharp is adjusting for that. That's the Sharp ratio is just the relationship between these two minus the risk-free rate. But this model is accurate. It chooses the correct direction 59% of the time as our directional symmetry. So here, this is just an example of what something could look like in terms of this sort of hybrid approach where you're generating these the signals quantitatively, but then this is what it looks like. And so the signal is just based on the relationship between Stoch RSI and then Stoch RSI trigger, which is just don't have to get into it, but it's kind of like a shorter moving average. And so when those cross above each other, that's with one's above the other, then that gives a signal. And so you could just take this, export it to Excel, or you could just say, okay, we're going to go along. This is on the weekly. And so this just gives you your signal. So yeah, it's interesting. Let me see if I get into do a plot for this one. So this is the signal. I'm sorry. It's the signal. It's here when the Stoch RSI crosses below the trigger, then we're going to be going short. It's very simple. I'm not getting into the details of this specific model, but we can go down and let's look at ticker. Oh wait, you know what? This one, for some reason, I tried this yesterday. It's not going to open. I'm just going to give an example again of working in pandas, but this should just be encouraging to anyone that doesn't program. With Python, you can learn so much so easily online, and then when you just get down to it and you want to do a quick assessment of the viability of a strategy, you can just, and it's very easy to read. If the stochastics RSI is greater than the stochastics RSI trigger, then we'll be long the next day. We're going to be trading it the next day, again, because this, one common pitfall is what's called the look ahead bias. You don't want to be taking the returns from the day that your signal comes. So that's all this +1 means here. So there's that. I'm not sure we're running on time here. I had one more Eller's model here. This is another one of his, I guess, somewhat well-known indicators. Is what's called the lead sign indicator. So let's just run this. So this is downloading the data down here. So this is going to take a little while to, typically when I run a script, I want to have some sort of output as it goes through every iteration. I guess I didn't do it on this one. Here we go. This is going to take a little longer. So we're going to see, again, the performance of each instrument. I can speak a little bit about this indicator. The lead sign, traders will know that when markets are consolidating, when they're ranging, the idealized model of that would be a sine wave, which is just, you know, like an S curve that goes up and down. And like, that's kind of like the human mind almost wants to see that when things are ranging, and obviously things are much noisier than that. But what Ehlers has done with this is he identifies the dominant cycle period and then creates a sine wave based on that. But then on top of that, projects that one day ahead. He anticipates turning points essentially through this indicator. And so you can see it's actually quite useful. I found it actually useful to, when I first read about it, he was talking about only using it and, you know, using your eyes, using this visually, and then only trading it when the indicator looks like a sine wave. But when markets start to trend, it actually kind of breaks down and it looks, you'll see, I'll show you a plot of this once we finish. We're halfway running this. But that's the interesting thing about this is, and this is why it's so, and I can't stress enough how important it is to be able to do your own research, is that, especially when you read a book, a lot of times I'll read books and they'll say, hey, you know, look, you test it yourself. And even then I've gone in and done it. And some of these things that people are purporting to work, they don't really work as advertised. But something like this, I actually thought of different interesting ways to use it. And Ehlers will actually suggest you do that. You know, he says these are ideas that can be used to as the beginning of a larger concept. This is a good example of how, I mean, looking at all these plots over here, that the important concept of diversification, and that, you know, some of these plots are, you know, quite erratic and have some drawdowns, but you're going to see the aggregate performance is actually pretty fair. Let's see here. All right, it's going to show that here in a second. This is obviously during over here, all the way to the right. Okay, here we go. So again, you have your aggregate return. These are the individual currency pairs, and then the individual performance. This has a Sharpe ratio of 0.6. The total return divided by max drawdown of 4. It's pretty good, but I did say I wanted to show you. So I have this is commented out. This is what in Python needed the 3 apostrophes here. Because I don't want that to run every time, but what I can do is just highlight and run this. Here's the lead sign indicator. So this is our stock. I think it's dollar stocky. This is the instantaneous trend line. As you can see, it has minimal lag. It starts to turn when the instrument is turning, but then here's our sign and lead sign plot, which I can put underneath it. And so the strategy is completely based on the relationship of these 2 plots. The lead sign is in blue. I'm looking down at the bottom here in the bottom right. And so all it says is when the lead sign, when the blue line is below, we're going to be short. And when it's above, we're going to be long. And you can see, this is what I was talking about. There's this when things are cyclical, it's going to be like a sine wave. But when things start to trend, like in here, it started to bounce, but then it didn't. So it indicates a trending market. And so, I mean, that's a completely different discussion, get into the details of how each of these things work. But it's just really important to be able to look for yourself, to see how things worked over the long term, and to decide if something actually has merit. Because there's just so many people, so many books. If I pick up a book going over technical analysis indicators, these authors, for the large part, are just cherry picking charts that support, their claims, and it's really easy to find something that looks good, or even several examples, because there's so much data. But it's really important to see how things work. If you're going to be putting your money behind something, you need to know how it really works, and that's really the essence. If you can remember anything from this discussion, I would really stress that the importance of being able to test an idea and, like as much data as you can get, and see what's really happening there, as opposed to what you hear on TV, what you read in a book, or even what you see for yourself, because that's really what the power of computing in general is scaling out human efforts. You're going to say, oh, I can see with my own two eyes. And it all starts with that too. I mean, you can still use the same process. Like, that's what we're saying here. That's what I'm trying to show. At the beginning, when we looked at these, the moving average crossover, or the performance after a run of a certain direction, you see those things, and you form a hypothesis, you have an idea, but then you want to see how it really works. And this is the best possible means to, quantitative research is the best possible means to arrive at the validity of an idea, to really to let you know if there's any truth or any merit to it. So I don't know, Sylvia, do you think that
I feel like I was in a quant class, basically. So
okay, good.
I'll welcome Dennis to take questions from the participants, and then maybe you can answer them.
Okay, sure. I'll leave my screen up for now, just in case you need to show something.
Okay, thank you for that presentation, Taka. So basically, what I want to ask, I'm going to ask my questions, and then I'm going to ask questions from the audience.
Sure.
With the current volatility in the markets right now, which automated systems do you guys see working well and are robust?
Well, in general, a lot of systems can be broken into two different, non-portfolio systems. Non-factor-based systems can be broken into trend following or mean reversion. So the more volatile markets are, the more you want to be using a mean reversion system. So as prices move to extreme, then you're just betting that they're going to return to normal. And that's I think it's kind of a broad assessment. So it's hard to speak specifically about systems, right? Because it gets so detailed, but that's just kind of my broad answer, I would say.
Okay, and another question. Now, what is the ideal look-back period you use when you back test? And how do you prevent biases, for example, which can arise from problems like curve fitting when you're conducting?
Sure, I mean, that's a really good question. Well, what's interesting is that as a default, if you're going to ask for a specific number, I would say 20 is like a common cycle period in markets that's, has been in the past in multiple time frames. However, one good thing to be aware of when you're testing, and I didn't really get into it, but there's all sorts of different things, right, that you can do in terms of avoiding a pitfall. what you want to look at you want to look at what is termed parameter sensitivity. And so you don't want a system that looks great when you have a moving average of 53, but looks terrible at 54 or 52. And what you can do actually is you can plot the return of your system's return based on the various settings. And you want to choose, and you can do this in 3 dimensions too, based on the number of variables that you're looking at. And you want to, and you'll see spikes sometimes, and that's obviously, there's so much noise, and so a spike in performance is probably due to a random event. You want to choose parameters that are part of a cluster of positive returns. Does that make sense?
Yeah, parameters that are part of positive returns.
Where the different parameter values all in that area of that setting have positive returns. Another thing that you can do to avoid that, which is really key, is if you are optimizing, you want to choose a wide range of step values. So if I was going to optimize a moving average, I wouldn't want to optimize values between 20 and 50 with a step value of 1, which would be 20, 21, 22. You want to just test 20, 30, 40, 50. Because otherwise you're going to be giving yourself false hope. I mean, you want to space it out, because the more you fine tune that, the more likely it's not going to be true.
Okay. Fantastic. So we have a couple of questions from the audience, and I'm going to read them out to you. And the first one by Calvin Kinothia. Calvin basically asked 3 questions, and I think all of them are good. So which Python libraries or packages do you use for automation? And is the code available on GitHub? Basically the code that you're using for your presentation.
It's not. And so for automation, it all depends on what your front end is, what you're using to execute trades. And so you have to go in and look at the API that's specific to that broker. And there's going to be all sorts of examples online. Now with Python, what you can use, it's a good question, that if you're going to be running something that's going to be automated, you want to use the time library, I think it's called, time. And what that'll do is it's going to run your script at whatever interval that you set. So you could have it run a few times a second, you could have it run once a day. And so that's it. I mean, that's a great example of how Python has such a huge community of users, and that if you can think of something, someone's got a library built for it probably. And not only that, when you start reading academic papers and some of these advanced functions, people have already built the functions, and then you can just use those packages to test a model.
Rupert wants to know how much does it cost for a trader to access the services of an automated system like this one? Given the fact that you also work in the institutional space, is this kind of service accessible to a retail trader at the retail level, especially when they are not using Python, they're using other platforms which are only compatible, platforms like MT5, which do not have the Python programming language?
Well, specifically, actually, Informa, the company I work for, we're actually rolling out a new feature where we have several rigorously tested models based on in the FX space, where users can have access to this, and that's going to be available soon. But on a regular basis, we're publishing signals from these models, and so there's actually even you can sign up for a free trial. Let me see, actually, if you contact, where is it? sales@informagm.com. That's INFORMAGM.com, sales@informa.com. You can get it set up. I think it might be a 2-week trial. I'm not sure about that, but you can just get a good taste of the extensive research that's provided from a lot of different areas. We also have just bread and butter technical analysis on, all the major FX pairs, but not only that, but commodities, equities, the fixed income. It's extensive and it's really useful and great value.
Yeah. Okay. Thank you for that, Taka.
Mm-hmm.
And one more question.
Sure.
But this Python, does it help filter out the noise, especially in FX?
Does it help me to what?
To filter out the noise.
Yeah.
Say, mm-hmm.
We touched on that a little bit at the beginning. That's the great thing about doing the research yourself, especially, is noise can be, there's noise in markets, there's noise on television, there's a lot of different ways to define that question. And programming is useful in every aspect with that. You can see how something works, really works with an evidence-based approach, as opposed to just hearing what someone says. And it's tough because, again, another cognitive bias is that we're hardwired to give weight to what we hear with our ears as opposed to what we read, relatively speaking, because that's how we evolved. I mean, that's the theory. And so if you hear someone say something, it's really easy to become, just give it more weight than it should, because it's a complex world we live in, and someone is on television and they're portrayed as an expert, and so especially people that aren't involved in the markets that much, it's easy to just hear something and just think, okay, well, he seems to know what he's talking about. You can really test and see how something works pretty easily. There's so many resources to learn. I would suggest, if you want to learn Python, to check out a book called, I think you can even get it for free at this point, called Learn Python the Hard Way. And it's just, all this stuff is free. All this, not the Bloomberg data I've been getting, but you can get so much free data from Yahoo, and there's so many great resources online. You can download Anaconda for free. All you need is internet access. And then within a few months, if you put the effort in, it's a lifelong skill to have. And we touched on it also. It's becoming more and more relevant in the workplace. Everything is moving to a more data-driven approach, and it's only going to continue in that direction. But then, just so I cover my grounds here in terms of the question, in terms of filtering out noise, one of the cool things you can do, I didn't get into it with this, but you can use, for instance, what's called a MARS algorithm, a multi-adaptive regression spleen. I don't know how to say that, but you can feed a bunch of, you can run a multivariate regression, which is just a fancy way of saying a regression on a number of variables. But this algorithmically can tell you, by regressing all the different features, it can tell you which of those features best describe the movement of a stock. And it's a machine learning concept called feature selection. So by running regressions, you can actually, and looking at the returns versus the, regressed against the variables, it can tell you with a reasonable accuracy of which of these indicate. You can even use technical indicators, and it can tell you which of these indicators actually explain what's going on. I mean, that's super powerful. I mean, I'm glad that I touched on that, because I remember when I first learned about this, as a trader, you see indicators, you say, okay, this is working, let's look at that, and you're just using your mind, and the human mind can only do so much. I mean, you can only see so much, but if you can use the power of computing to do, machine learning to do feature selection to tell you, and this is, I'm using this example because in essence, you're filtering out the noise, you're filtering out the stuff that has nothing to do with why these stocks, FX pairs are moving in a certain direction. So that's, just look up feature selection online. That's another, there's a lot of stuff about that to look into.
Okay, thank you. That's it. I'll hand it over to Sylvia to conclude. And thank you once again, Taka. I really hope that we can have you next time.
My pleasure. Yeah.
Break things into more detail in terms of strategies.
Absolutely. Absolutely. Anytime. It's been a great pleasure. And yeah,
Right.
love to come back.
Matthew, thank you very much for your time. And then it might seem as though this is complicated, but thank you for affirming, that we can actually self-educate when it comes to programming, and as long as we have the internet, and the opportunities are endless. So thank you so much. And
Absolutely. My pleasure, Sylvia. Okay. Right. Sounds good. Have a good day.
Bye.
Bye.
Thanks guys for tuning in and sticking with us to the end. We hope you have learned something new. I would like to appreciate Scope Markets for sponsoring this webinar. Remember, you can open a live trading account with Scope Markets and apply the lessons shared by the guest in this webinar to your trading. Many thanks to our guests for speaking to us. We'll be open to have you in the future. Till next time, goodbye.